When the rest of the markets slow down, the futures market keeps moving. Did you know that CME Group S&P 500 and NASDAQ 100 futures trade nearly 24 hours with great liquidity? In the ETF markets, volume and liquidity lessens after 4 p.m. until the next morning. But with futures, you get trading opportunities both day and night. Learn more at cmegroup.com/equity-futures.
This holiday season is likely to be a roller coaster for logistics and manufacturing, but having the right staff in place can be easy when you choose Express Employment Professionals. They can handle everything to ensure you have the right size contract workforce. Go to expresspros.com. Solve your workforce challenges when you choose Express to support your hiring in a variety of roles, including 2 of our biggest areas, manufacturing and logistics. Visit expresspros.com today. That's expresspros.com.
These days, AI can help you adopt better time management, but it can't stop colleagues booking meetings during lunch. But how about being able to easily adopt industrial AI to streamline your business? Siemens Accelerator helps you find the right AI providers and easily understand what they offer, so you can use modular solutions to quickly scale up and grow your business. That's AI for real, from the global market leader in industrial AI, Siemens. Learn more on usa.siemens.com/AI.
Bloomberg Audio Studios. Podcasts, radio, news.
That wraps up the news conference with Chairman Powell down in Washington, D.C. Here in New York City, we're reacting to a 25 basis point rate cut from the Federal Reserve, a dissent pushing for 50 basis points, and a huge debate about the future. Anna Wong of Bloomberg Economics with this to say: I have not seen a meeting with so many contradictions. This is a low-conviction Federal Reserve with limited visibility and a very wide range of views on the future. And this is why this market is so confused, captured by this move in the equity market on the S&P 500. Move lower, move higher, all over the place. This market is somewhat shaken. Bramo, this Federal Reserve has no idea what 2026 is going to bring, and this chairman did his best to articulate that.
And I don't know that he sent a clear message because it's not possible to send a clear message. That sound you hear, that's the idea of forward guidance dying. Because ultimately, how can a Federal Reserve with this level of dispersion in views really give any sense of their reaction function? And to me, the idea that he said there wasn't widespread support at all for a 50 basis point rate cut and talking about this as a risk management rate cut flew in the face of the hopes and dreams of markets that were hoping for a bit more.
And that's brilliant about forward guidance just evaporating. And John, it goes back to when you looked into the other room here, the south wing of our studios, and you looked at the dot plot, and the dispersion looked like a B-52 bomber's wingspan.
Massive spread.
Massive.
We can talk about it right now, TK. At the very bottom of that spread is a dot that's basically projecting a massive amount of rate cuts for the year ahead.
It's a political dot.
A sub 3% dot. Tom, look above it. You've also got a dot there that's looking for a Federal Reserve that could be hiking interest rates over the next several meetings. These dots are all over the place, and Bramo, you nailed it. A risk management rate cut, two-sided risk, no risk-free path in a meeting-by-meeting situation. I think the chairman did his best here to form a consensus that probably didn't exist on the committee when they got together for the first day just yesterday.
Yeah, I think that that's well said. He even talked about the labor market, that clearly you can no longer say it's very solid. But then he went on to say that any kind of headline disappointment was due to the immigration picture, probably in a significant part. This is the reason why it is a Federal Reserve that is unable to really present forward guidance, because ultimately we don't even know who will be doing the guiding and who will be doing the decision-making come next year. And that is the reason why there's so many questions about that outlier. Tom called it a political dot. That political dot potentially has quite a bit of weight.
It might be a flavour of things to come in 26 and beyond. Joining us now to discuss, the former New York Fed President, Bill Dudley. Bill, welcome to the programme, sir. A lot to process here, many contradictions. Is that a fair way of describing this meeting?
I think there's a lot of tension between the inflation outlook and the labor market outlook, but I think Powell said it pretty well. I mean, he said basically we think that the risks on the unemployment side have risen more than the risks on the inflation side. And so given that, we should be less restrictive. And so we're taking out essentially a risk management cut to reflect the fact that the risks on the labor market seem to be a little bit higher. After that, there's a lot of uncertainty about, how that's going to evolve in 2026. 2026 and 2027. And the committee, is split about what to do going forward. I think it's interesting. The market reaction initially was like, oh, gee, 2 more rate cuts this year. And then I think people parsed the summary of economic projections a little bit more and realized that it was actually 9 to 9 plus Murren. So 9 people wanted either no more cuts or 1 more cut. And 9 wanted 2 more cuts. And then there was Steve Murren, who I'm absolutely confident that's his dot.
Well, Bill, I think a lot of people would agree with you. I just wonder going forward how much you are satisfied by Fed Chair Powell's response to why they're upgrading their expectation for inflation, why they always put the idea of 2% 2 years out, and why they are still cutting even though they have not achieved that in more than 5 years.
Well, if he didn't think policy was restrictive today, then they certainly wouldn't have cut. But he's starting with the premise that policy is restrictive; it's exerting downward restraint on the economy, and basically, given that the balance of the risk have shifted towards greater risks to the downside on the labor market side, he wants policy to be somewhat less restrictive. So this is a very modest adjustment, and I don't think there's a lot of I don't think there's forward guidance at this point really that's meaningful, because it really is going to depend on how the market. The economy evolves. I mean, look at the data just over the last couple of months. We have weakness in the labor market, and then we seem to have strength in terms of GDP and spending. So the Atlanta Fed GDP now forecast for the third quarter is at 3.4%. So there's a lot of uncertainty on the outlook. But this is an insurance rate cut. That's all it is, and it doesn't really foreshadow what's going to happen going forward.
Bill Dudley, you're one of our best at dovetailing the dynamics of market economics into our academics. I think of Robert Hall, who was at Berkeley, and he went over to a school across the bay. I can't remember the name of it right now. Bill, I look at the inflation. Let's take East Hampton, Massachusetts, where when you were a kid, you were in school there. Sewage rates are up 33% in the last 24 months. Is this a Fed looking at a purchasing power crisis for too many Americans out to the December 10th meeting and into next year?
Well, there's definitely a squeeze on low-income households. They don't benefit by the rise in the stock market. They don't benefit by the fact that they're locked. They hold 3% mortgages. They're hurt by the higher tariffs. They're hurt by the weaker labor market, and so it's really a tale of two economies in terms of the outlook. Monetary policy is a very blunt instrument, and unfortunately, the Fed can't calibrate monetary policy to sort of equally help everybody in the current environment.
So who do they do it for, John? Global Wall Street? Is that the mandate?
I was thinking back to, TK, my days back at school when I was a kid. If I kept telling my mum, in 2 years I'll do better, in 2 years I'll do better, I'm sure my mum at some point would lose patience. Bill, should we lose patience with this Federal Reserve? What is this? In 2 years' time, we'll hit our inflation target. In 2 years' time, we'll hit our inflation target. Mike McKee addressed this in the news conference, and I actually think it's a really important moment. How credible is this pursuit of 2%?
Well, I think it's a fair point that, it's always 2 years later we're going to finally achieve our inflation objective. The Fed's basically trying to, as Chair Powell made it very clear, they're trying to balance the fact that the two goals are in tension. And so if they just focused on driving immediately to the 2% inflation goal, that would lead to much higher unemployment. And so they want to balance those two risks. But, the risk to the Fed is that every year you continue to go with inflation above 2%. The risk is that inflation expectations finally become unanchored. And the attacks on the Fed's independence obviously increase that risk.
Bill Dudley with the latest. Thank you, sir. Appreciate your reaction. Brilliant. Thanks for standing by. The former New York Fed president, Mike McKee, was in that news conference. It was an important moment, I think, and Mike McKee joins us now for more. Mike, first of all, your assessment of the last 60 minutes or so, and what did you make of that exchange you had with the Fed chair?
Well, the last 60 minutes or so, I think Jay Powell was trying to walk a very fine line because he's got a very divided committee. Nobody is sure what's going to happen going forward except for Stephen Myron, who thinks that things are going to be absolutely rosy and we need to cut rates a lot. Everyone else is uncertain. And the dot plot median shows 2 rate cuts this year. But when you look at the dot plot itself, it's so narrowly divided that you really can't take any signal from it, as Bill Dudley was saying. So Powell is trying to tell people that we really don't know without saying we really don't know. And as Bill said, trying to make this an insurance cut. The 2% thing, I think, is a real question for them. And he didn't really give a good answer to my question. It's not just that that inflation expectations become unanchored, but that higher expectations can become embedded. And people don't think you're going to get it down farther. And so then how do you fight that going forward if you can't make any progress or can't be seen to be making any progress towards your target?
Mike, while you're down there, since you are in the room, it sounded like Fed press conference language. We did get a statement. We did get a rate decision. But can you tell us and just describe to us how different this Fed meeting felt, what it looked like, what kind of changes were made?
Well, I'll tell you, there's a lot more press here than usual. That's one thing that it looked like. The changes are the kind of things that you would see in the statement when they're changing policy, which they did. The dot plot may be a little bit more confusing, less guidance in it than we had seen before. And there was obviously some tension between what the rate cut medians were with what the economic projection medians were. But overall, it went off pretty much as they usually do. The Fed statement wasn't that unusual. There obviously was the big elephant in the room of Stephen Myron that the chairman declined to comment on. He also declined to comment on Lisa Cook. He tried to keep it just to the Fed. So it really wasn't a hugely different dynamic, except that there were a lot more moving parts than we often see, or at least than we've seen in a number of years.
Mike, just before you go, there was a moment there where I do think he addressed the Governor Myron question, the importance of one individual on the committee and how much sway they have on the FOMC, how they've got to persuade the other individuals in the room. And Mike, I think it begs the question, if that Stephen Myron dot, that Governor Myron dot, sub 3%, is a flavour of things to come, Mike, to what extent this committee will push back?
Well, clearly the committee pushed back today, and we didn't see a dissent from Mickey Bowman or Chris Waller. So they seem to be satisfied with where they are at the moment. And that suggests that Stephen Myron is not going to have a lot of influence. Nobody really expected him to. It does raise the question, though, John, as you sort of imply there, that if the president gets more people on the board, where do we go from here? And the Myron dot is a sign that the president's people would definitely try to push rates lower, whether or not the economy justifies it.
Mike McKee with the latest. Mike, a clinic as always. You're one of the very best. Appreciate your time. I think it would be a massive mistake just to say that's all political. We had this conversation with Greg Peters of PGIM right before the news conference. He said what's political and what's real. Whatever you think is political right now might be real next year. And that might be a flavour of what's still to come from the incoming chairman for 2026. And it's not just about being able to persuade the rest of the committee. It's a question about how credible it will be with fixed income and broader markets.
And right now, it seems like it was credible to the extent that it's not causing some sort of massive sell-off in long-term yields. I do think it's notable that there was only one dissent about a 50 basis point rate cut. And I think we have to keep going back to that Stephen Myron was alone. He didn't get a sort of concurrent opinion from Mickey Bowman or Chris Waller.
We're going to get to Jeff Rosenberg, but John, I was going to go to Mike on this. So let me just bring it up. April 29 next year, June 17th next year, July 29. I think there's an election just after the October 28 meeting. When does House politics or even Senate politics come into this discussion with a vengeance? I don't know when it is.
I think we're right there right now.
Yeah.
You know, before this decision, Tom, we sat around the table and I said this is the last set of forecasts you'll get from Chairman Powell without knowing who the incoming Fed chair is going to be. Yeah. And I think we can say that. By the time we get to December, we'll know who the Fed chair is. We expect to know who the Fed chair is. And you're also going to know what they think about where policy should be in 2026. And that's going to bring a very different flavour to the meeting at the end of this year. Chairman Powell did the best job he could possibly do in that news conference, given all the contradictions of this moment. Not just about the contradictions within the committee, the contradictions almost all over the place. The fact we've had the step down in payrolls growth that we've had, and unemployment has been super stable over that period. The fact we're looking for a better growth profile for 26, yet at the same time we're talking about more rate cuts, not less. It's a very unusual environment, and I think the chairman did the best he could do, given the circumstances, to communicate that.
Yeah, and I think that if you did sound a little bit like word salad occasionally, it probably was to be forgiven just based on the fact that there aren't good answers to any of these things, especially given the dissent that you're getting on the committee.
Jeff Rosenberg of BlackRock joins us now for more. Jeff, welcome to the program. We often say, you and I, the first move isn't always the right move, and we'll see if it sticks in financial markets. But what do you make of this move in response to some of the contradictions we've heard over the last 90 minutes?
Yeah, you guys have covered a lot of it. I'd say, the three big takeaways for me, number one, it's the validation of the Waller-Bowman critique from the summer. It's not unexpected, but it's important to recognize, that was the first thing that the markets reacted to, the change in language in the statement. And it clearly was echoed by Powell in the press conference that the impact of the revisions on the data, he kind of focused on it and then said, well, it's not just that, but then he went back to it again and again. And so that was the first takeaway, is this labor market slowdown has clearly resonated. It's shifted the balance of risks. And that was the initial market reaction. Rates went lower and they were a bit positive on that. But when we got into the press conference, it became a little bit less focus on that and more about the forward 2026, 2027 outlook. And that's where my second point is kind of a big takeaway here, is that the bond market and the year-end 25 outlook are basically aligned. It's when you look further out into those projections relative to where the bond market is pricing where there's a lot of disagreement. And it gets to this notion of the spread that you were talking about before in the dots as you look at the dispersion there. And finally here, I think you mentioned it before, going into the meeting, there was a lot of, uncertainty about whether you'd get more than one dissent, whether Waller and Bowman would advocate for a faster move. They didn't. They were kind of on board with this adoption of the balance of risk shifting. And I think that's important in terms of validating that earlier point I just made, that bond markets for the end of this year are kind of right on line with where the Fed is. I think the disconnect into next year is interesting, and that's going to have to be resolved.
I guess, Jeff, how much does this increase the weight of just how many seats the president has to fill, given the fact that, as John and Tom were talking about, we did see pushback from the other members from going 50 basis points? We didn't see that coalescing around that view.
Yeah, that's going to be a big issue. And I think that's part of what you're seeing in terms of the disconnect between the dots today and the bond market expectations for the path of policy rates in 2026, because the path of actual policy rates is what the bond market is pricing. And the path that's written down today is based on the current makeup. Right. And so that's where you see effectively a disconnect in the bond market incorporating the possibility of a different makeup of the FOMC underlying the expectations or the distribution of outcomes for where policy rates evolve beyond the near term, where you see really clear alignment.
Jeff Rosenberg, I assume you survived probability and statistics at Tepper at Carnegie Mellon. What's the standard error these fancy guys at the Fed are working with? How certain can we be of the path forward? Or are they really making it up meeting to meeting as they go?
Yeah, it gets to this dispersion within the dots, and it gets to something Powell he mentioned a couple of times, which I think is a really important way of thinking about and framing this moment in time for the bond market and for how the bond market follows what the Fed does. And he said there is no risk-free path. And that's a really important concept. Yeah. And what he means by no risk-free path is that there's risks to erring on the dual mandate. A little question about the third mandate in there later, but there's a risk to the dual mandate if you pursue the maximum employment and you put the inflation at risk, and vice versa. If you focus on inflation, you put the employment at risk. And that's a very uncomfortable and unfamiliar spot. We called it, before we got into the post-COVID environment of too much inflation, we called it divine coincidence of monetary policy. The policy mandates were aligned. They never faced that conflict. And so bond markets never faced the uncertainty that the dispersion in the dots is reflecting. And there's really no resolution of that. It's going to be the data and what is the marginal change in data that the market's focused on, that the Fed's focused on. And the marginal change is that employment has been the big downward revision. inflation has kind of been persistently above target, as we talked about going on 5 years in the projections, but it's not accelerating. And that's the key. It's what's the rate of change between the dual mandate. Right now, it's all on the labor markets, and that's going to keep its focus. That may change, and as that changes, so
absolutely
will the market,
brilliant. John,
pricing.
what this amounts to is it a new data dependency?
They've made a choice. And I think we should respect that fact. Jeff, you can always fall into the trap of suggesting what the Fed should do, what it shouldn't do. Jeff, the chairman's saying there's no risk-free path, but the committee's made a choice to cut interest rates, to signal more to come. If there is a consensus, it's to cut again, and cut again. Now, Jeff, as a market participant, you've got to respect that the Federal Reserve has made a choice to take that risk. And I want to understand from your perspective how credible you think the pursuit of 2% actually is. And as a bond investor, how your approach to a market should change given the information that you've had this afternoon.
Well, and it was in your conversation with Mike McGee and his question, the risk is they lose credibility on the 2% number. Now, you can get stable prices at 3%. As long as it's not accelerating, but you're not reaching your target. So it's shifting the target and you lose the credibility and the anchoring to a 2% level. What does that mean? It means a higher level of long-term interest rates. It means a higher level of term premium. And to the extent that you get more variability as a result of not only hitting 2%, but being persistently above it, you get a higher inflation risk premium. And all those things factor into how we price in term premium, the value of the long end of the curve, the value of inflation and inflation protection. And the longer you go on above that 2% target, the more and more we start to price those things in. But my earlier comments is right now everybody's focused on the labor markets. And the key here, the key presumption that we're going to test is that inflation that's still coming down the pipe in terms of the tariff pass-through, is that one-off? Everyone's pricing it in to be one-off. Hopefully that's correct. But the data and the evolution of the data and the relative change between the inflation and the labor market data is going to shift that focus. Right now, the back end's pretty contained because the inflation data isn't accelerating at the same time as the labor market is decelerating.
Yeah, but Jeff, to build on what John's talking about, if this is essentially a central bank that has chosen, and they chose the labor market over inflation, then you would expect there to be a much bigger risk premium on some of the long-term bond yields. It's come off. And I just wonder if, let's say, President Trump selects Chris Waller to be the next Fed chair, how much does that risk premium come back because it takes off the prospect of more aggressive yield curve control? In other words, how much is a sort of subdued reaction in long-term bonds sort of predicated on this idea that this will be a very creative Federal Reserve and a very creative Treasury Department?
I mean, I think on the prospects of innovation and a change in policy, I think a lot of it will have to be the actual actions as opposed to the potential for those actions. Very hard for the bond market to price in those changes in policy until the likelihood of those other scenarios in terms of policy innovation are more clearly identifiable in terms of the probabilities. Right now, they remain kind of in the realm of possibility, but as long as they're in the realm and not in the likelihood, it's hard to price those things in. I think the second piece around it is really going to be how the data evolves to inform both those policy choices and the relative trade-off between this lack of risk-free path. If inflation is accelerating and the labor markets are not decelerating, then the shift in the focus can flip to inflation. How do policymakers react to that? And is that reaction consistent with how the bond market is pricing? I think that's how we'll evolve as we see these changes in policy alongside the changes in data.
If we get Chair Rick Reeder, I'm loading up on bonds. Okay, Jeff? I'm going to let you go. You don't have to respond to that. Don't get in trouble.
Thank you very much.
You run. Jeff Rosenberg of BlackRock. Thank you, sir. Governor Myron, what are the odds he becomes Chairman Myron? What are the odds that someone like him joins the committee? And what would that do to the perception of this Federal Reserve? And how would it change financial markets? That dot there is really, really important for 2026 and how we should be thinking about this institution and what their approach will be, how it will change, how persuasive, how credible it might be. We've got to ask some big, big questions about next year for monetary policy and financial markets.
Yeah, and the difficulty in understanding whether the market is actually responding to that dot, right? Are we getting a sense of what the market's reaction would be to that type of approach to monetary policy, or are people dismissing it? This is not somebody who was able to get some of the other members to come on board with him. And so it is just one person on a committee.
More than ages, years, I'm looking meeting to meeting to meeting. It's a Fed that's going to be overcome by events.
Will you wake up a little bit earlier and join us tomorrow? Do you fancy that?
I can do it.
Are you going to stay in bed?
Come in. No,
What do we have to pay TK to make you wake up earlier in the morning?
I got the Bentley. It's getting the car down Fifth Avenue is really difficult.
It's difficult.
But if you want,
they talk about the haves and the have-nots.
Yeah. Talk to my people.
This right here.
Just buy a Bentley.
For enterprise organizations, managing all your food needs is a tall order. But with EasyCater, you get a single workplace food vendor with the tools and resources to make it easy, giving teams across your organization an easy way to order from a huge variety of restaurants, all on one platform. All while consolidating your corporate food spend so you can control costs, streamline billing and payment, and simplify reporting. EasyCater, your business tool for food. To learn more, visit easycater.com/podcast.
There's nothing like sinking into luxury. At WashableSofas.com, you'll find the Anabay sofa, which combines ultimate comfort and design at an affordable price. And get this, it's the only sofa that's fully machine washable from top to bottom, starting at only $699. The stain-resistant performance fabric slipcovers and cloud-like frame duvet can go straight into your wash. Perfect for anyone with kids, pets, or anyone who loves an easy-to-clean, spotless sofa. With a modular design and changeable slipcovers, you can customize your sofa to fit any space and style. Whether you need a single chair, love seat, or a luxuriously large sectional, Anabay has you covered. Visit WashableSofas.com to upgrade your home. Right now, you can shop up to 60% off store-wide with a 30-day money-back guarantee. Shop now at WashableSofas.com. Add a little to your life. Offers are subject to change and certain restrictions may apply.
Every business has an ambition. PayPal Open is the platform designed to help you grow into yours. With business loans so you can expand and access to hundreds of millions of PayPal customers worldwide. And your customers can pay all the ways they want with PayPal, Venmo, Pay Later, and all major cards, so you can focus on scaling up. When it's time to get growing, there's one platform for all business. PayPal Open. Grow today at paypalopen.com. Loans subject to approval in available locations.